Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Cut to the Chase. Now on this podcast, we've had a relatively disproportionate focus on US data and events this year given how dominant they have been on most markets globally. But today I want to shift focus to Europe and the euro currency. Now, besides short-term technicals, of course, the euro is facing two big events in the coming weeks, the ECB policy meeting and French elections, besides, of course, the impact of the ongoing conflict in Ukraine. Now, to start with the ECB, the central bank is facing a particularly difficult dilemma today, and we believe this uncertainty continues to be one of the main sources of weakness for the euro. Now, I started my day today by taking a glance at the ECB website, and they are pretty clear that the primary objective of ECB monetary policy is to maintain price stability around 2%. Now, this has been difficult to do recently, of course, with headline inflation climbing as high as 7.5%, though, to be fair, this has been led primarily by spiking energy prices. Now, the ECB meets to set policy this Thursday, and we believe their decision and messaging will be shaped by three main factors. The first, of course, is the trade-off between inflation and growth. On its own, inflation does, of course, argue for higher interest rates and lower bond purchases. Indeed, this reflects the view of one camp of ECB policymakers. However, the central bank has also acknowledged before that the high inflation numbers are being led to a large degree by supply-side factors like energy prices and supply chain disruptions, both of which on monetary policy has little effect. Now, this rise in inflation also comes at a time when the growth outlook for the EU looks relatively weak, with consumer and business confidence indicators, for instance, looking weak. Now, all of these, of course, contrast to a large degree with the US and the Fed decision, where growth is arguably much stronger and inflation arguably driven additionally by strong demand factors in areas like housing. Now, the second factor, of course, likely to impact the ECB decision is Europe-wide bond yields. Now, one ongoing concern is that if the ECB were to slow or stop bond purchases and raise interest rates, such a decision may disproportionately impact bond yields in peripheral Europe, tightening financial conditions for those economies by far more than intended. Now, indeed, this has been the factor behind calls to either raise rates while continuing bond purchases or making more rapid progress towards a greater fiscal union. Finally, the efforts to impose new sanctions on Russia continue to be an outside risk. The main market concern here, of course, is that any move to sanction Russian energy imports in a significant way could raise stagflation risks in Europe by pushing inflation higher while tipping some EU economies into a recession. Now, all of this, of course, on the ECB, of course, but we should not also forget that the upcoming French presidential election is another risk hanging over the euro. While incumbent President Macron beat his nearest rival Le Pen by a comfortable margin in the first vote, polls show the gap between the two remains very narrow, within the statistical margin of error, actually, for the second runoff round between the two candidates. The market's fear, of course, is that a victory by Eurosceptic Le Pen would risk creating a new political crisis in Europe, just at a time when markets are arguably looking for greater EU unity, not less, in areas like fiscal policy. So where does all of this leave the euro? We believe the near-term direction for the currency remains to the downside, particularly for the euro-dollar pair. Now, without a significant shift in direction of ECB policy, we expect any rebound in the pair is likely to be limited to technical resistance around 1.0975. Initial negative momentum is likely to target key support at 1.08, but a break of this opens up a possible move to the subsequent support at 1.0635. Now, this bearish near-term view should eventually give way to a stronger euro over a 6 to 12-month horizon, of course, but that shift is likely to require the policy gap between the Fed and the ECB to start narrowing, likely driven, of course, by a more hawkish ECB at some point. So overall, our key takeaway is that a weaker euro in the short term, but long-term strength only coming through over a longer 6 to 12-month horizon. If you enjoyed this podcast, please don't forget to rate and like it. Thanks again for listening and wish you a happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.